If you have ever traded live, you probably know what a broker is. But have you ever actually known what kind of broker you're dealing with? Did you ever learn about the difference between a dealing and a non-dealing broker? Because if not, we're going to break down everything in today's video. Hello everybody and welcome back to the channel. Today we're going to take a deep dive into one of the most crucial aspects of Forex trading, which are the people that actually move the markets, the market participants. So by the end of this video, you will have a clearer picture of who influences the Forex market and how that might impact your next trading decision. So let's get started. To begin with, it's important to understand that the Forex market is not one single entity. It is a network of market participants, each of them playing a specific role in driving price movement and liquidity. At the core of this network stand banks, specifically commercial banks. These institutions act as intermediaries, facilitating currency transactions for individuals, businesses, and governments. But at the same time, they are market participants themselves, trading currencies to manage their own exposure. Because of the size of the banks and the volume they trade, their activity can influence short-term price movements and even broader market trends. In addition to that, the banks provide their clients with access to currency trading, allowing them to speculate or even hedge their positions. Collectively, all of these banks form something known as the interbank market, and this includes very known institutions like JP Morgan, Goldman Sachs, Barclays, Deutsche Bank, and Bank of America. Another key group of participants are governments and central banks, because they shape the Forex market through monetary and fiscal policy. Because central banks such as the Federal Reserve or the European Central Bank have the authority to set interest rates and implement monetary policy decisions that can lead to significant movements in the Forex market. Governments may even intervene directly into the market just to influence their currency's value, which is a practice known as currency intervention. And if you've ever looked at the charts during news time, you know that economic data releases can cause quite the huge spikes in the intraday market. Next on the list, we have brokers. Brokers are also intermediaries, but this time they are providing the platforms for you to actually be able to execute your trades. However, not all brokers operate the same. It's important to distinguish between non-dealing desk brokers and dealing desk brokers. And the distinction is important because it affects how your trades are being executed. So dealing desk brokers are often referred to as market makers because they create their own internal market for trade execution. They provide their own liquidity and they quote their own prices. So when you place a trade, they take the opposite side, meaning that when you buy, they sell to you, and when you sell, they buy from you. While this model allows for straightforward execution, it's oftentimes a conflict of interest, because the broker actually makes money when you lose. And historically speaking, some market makers even engaged in stop-loss manipulation, but thankfully regulatory oversight in many jurisdictions has minimized the likelihood of such events. To better understand a dealing desk broker, consider this analogy. Imagine working with a real estate agent who owns several properties. The agent now shows you their own homes and offers you a price based on their own evaluation. In this case, there is no external market influencing the price, and it is determined solely by the agent. And this is similar to how a dealing desk broker operates. In contrast, a non-dealing desk broker does not create their own market, and they also don't take the opposite side of your trade. Instead, they just route your trades to a broader Forex market where your trade is matched with some other participant. So the non-dealing desk broker basically facilitates your execution rather than act as a counterparty. So using the previous analogy, you now have your real estate agent who doesn't show you any of his personal homes. You describe what you are looking for, and now the agent goes and tries to find some seller that matches your criteria. So the price here is determined by the market conditions and not by the agent himself. Non-dealing desk brokers usually operate using ECN or STP models. So ECN, Electronic Communication Network, connects traders directly with a network of participants, including banks, hedge funds, and other traders. They try to match the order, providing direct market access and even often faster executions. STP stands for straight-through processing, and this one routes orders to multiple liquidity providers. Each provider offers its own pricing, and the system automatically selects the most competitive option available. Some brokers combine both approaches in a hybrid model and offer greater flexibility in execution. Ultimately, the choice between the different models depends on your experiences, your trading style, and your preferences. Another important aspect to consider is regulation, because regulators are the organizations that actually establish and maintain rules within the Forex market to ensure fair and transparent operations. While each country has their own regulatory bodies, there are some of them that are globally known, such as the SEC, the FCA, the FCCA, and many others. Brokers can be either regulated or unregulated. A regulated broker operates under these strict guidelines and structures, while the unregulated broker doesn't. So they basically have no external supervision. Finally, we have speculators. Speculators participate in the Forex market with the goal of profiting from short-term price fluctuations. Hedge funds, due to their size and capital, can significantly influence the markets, while retail traders operate on a slightly smaller scale. Now that we've covered the majority of market participants, let's talk about liquidity providers. Liquidity providers, often referred to as LPs, are another fundamental part of the Forex market, because they are responsible for providing those buy and sell prices you see while trading, as well as ensuring that there is sufficient volume available. So simply put, they make it possible that trades can actually occur by ensuring that there is always a counterparty available. The LPs influence the trading market in different ways. They establish the bid and ask prices, which are the foundation of all transactions. Furthermore, they promote competitive pricing by minimizing the spread between the buying and selling prices. They ensure market availability by maintaining continuous liquidity, and they contribute to overall market stability by reducing the likelihood of extreme price movements. Without sufficient liquidity providers, the market would become less efficient, with wider spreads and less trading opportunities. Understanding the market participants, from banks to central banks, from brokers to liquidity providers, gives you a more complete view of how the Forex market works. It allows you to move beyond simply reading charts and actually understanding why the market moves. If you found this explanation helpful, then give it a like, share it with other traders, and subscribe to never miss any more episodes. And I'll see you in the next one.
Hola Prime, trade with transparency.